All right, everybody, we have a new king in Canada. Shopify has officially passed the Royal Bank of Canada as the largest company in the country. Back on the TCI podcast at the start of the year, I had predicted this would happen. However, I also predicted that a particular curse in the market would kind of reverse order and would not occur to Shopify. I'm going to dive into Shopify's earnings, this curse overall, which is scarily accurate over the last, 20, 25 years. And I'm also going to dig into whether I think Shopify is still a buy and show you some very important valuation metrics that might give a bit of context as to why this is so much different than the run-up in 2021. So as always, everybody, like the video, subscribe to the channel. Right now, we are running a premium promotion. It is going on today. I believe we opened up 50 spots. It's a huge discount, 50 spots open. I would imagine right now we're closing in on the last few spots because we opened up the deal this morning. So if you want to grab premium with a 30-day subscription back guarantee, I'll throw a link in the description. You get a big discount off your first year. You can get into the platform, try it for 30 days. If you don't like it, shoot me an email and I'll refund you in full. That's how confident I am the platform is going to make you a better investor. But let's get right into the video. So first off, before I dive into Shopify, I just want to go over this curse. Now, there has been a long-standing curse. It's actually been dubbed the Royal Bank curse, and that is whatever company overtakes Royal Bank on the Toronto Stock Exchange goes on to perform absolutely terribly for the next while. And I don't even have to flip this chart here to show you the situation of Shopify. Back in 2020, it became the largest company in the country by quite a wide margin. Actually, we're looking at 264 billion to 188 billion of Royal Bank. This was primarily because of the pandemic-fueled environment, lots of e-commerce, lots of businesses going to Shopify because the retail landscape was closed down. Everybody had to order digitally. There was a lot of merchants who operate brick and mortar stores that had to open up digital stores because they were locked down. Now, what happened in 2022, lockouts kind of ended. And also there was just a big fall off in Shopify's overall results. The company even came out and stated that there was a lot of growth pulled into 2020 and 2021 that it had projected in future years, and it kind of missed the ball when it came to its guidance. So Shopify fell by a lot. I mean, we're talking about a market cap of 264 billion all the way down to 50 billion. So we're, wiped out almost 80% of the company. Now, the other instances this has occurred, the old Royal Bank curse, would be, for one, Nortel. We can see this article from 2004. Nortel reclaims the top of the TSX mountain. Well, this did not last very long. It was the largest company in the country. They ended up being a massive scandal. They ended up redoing a lot of their financial reports, which turns profits into massive losses. And eventually the company just went under. This would have been during the dot-com boom. The other instance we have is BlackBerry. Now, BlackBerry during the financial crisis, I want to say even before that, was huge. The smartphone, they were the industry leader in smartphones. They were absolutely exploding. They peaked at a market cap of around $135 billion. And this was back in 2007. Could you imagine BlackBerry? Right now, they have a market cap of $3 billion. They were once a $150 billion company nearly. They surpassed Royal Bank. Shortly thereafter, they would go on to get pretty much obliterated over the next 3-4 years. Again, Royal Bank reclaimed its title of top TSX stock. The next one we can go over, and is actually a very brief stint, would be Ovintiv. Now, back then, they were Encana, so they are a natural gas company, and back in 2006, for a very brief stint here, they became larger than the Royal Bank of Canada, and it would go on to perform very poorly over the next, I want to say close to 10 years. We're looking at a market cap of around 24 billion in 2005, and we're looking at a market cap of only 4 billion by 2016. It still struggled quite a bit, but again, the curse lived on. The next one would be Suncor. So Suncor, very, very briefly during the financial crisis, ended up topping Royal Bank in terms of market cap, and it would then go on to pretty much crash, going from a market cap of around 65 billion down to a market cap of around 20 very, very shortly after. And this was primarily due to the fallout from the financial crisis, things like that. It did quickly recover, but never really came close to matching Royal Bank again. And finally, this is probably the one that a lot of people don't know about, is Bausch Health. Now, back then, they would have actually been known as Valiant Pharmaceuticals. Now, they went on a absolute launch in 2014, 2015. They got to a market cap of around 118 billion, whereas Royal Bank was 111. And again, it just absolutely collapsed. It's now a market cap of 2.9 billion. So every single company that has surpassed the Royal Bank as one of the largest companies in the country has gone on to have a massive, massive drawdown. Now, as I predicted at the start of the year, Shopify will go on to exceed it, but I do not think the curse will come into effect this time around. This company is just growing too fast. If we look to the most recent quarter, the company achieved 31% revenue growth and again 16% free cash flow margins, which is relatively in line with what they've done existing. Now, the company is up 20% on earnings. They reported yesterday, and just overall, it just seems like nothing can stop this company right now. Now, keep in mind, this was an over and above better quarter than expected. Even I did not expect the company to report this good of a quarter. We're looking at gross merchandise volume of $87 billion. In 2024, that was $67 billion. So again, 31% growth. Monthly recurring revenue, $185 million compared to $169 million. As a result, we're seeing, a near $650 million increase in revenue. Profits are up. Operating income was up, free cash flow is up. It's just been an outstanding quarter for Shopify. If we look to gross merchandise volume, this chart, it's just dreamy looking, to be honest. We're looking at, over the last trailing 12 months, $326 billion in gross merchandise volume. And when we look to the blue, which would be the gross payments volume, and this is the amount of gross merchandise volume that is handled through Shopify payments. The one thing you're going to notice is that it is a much larger chunk than what it used to be. And ultimately, the more that Shopify is processing through Shopify payments, the more take rate it can take and the more money it makes. So if we look back to 2020, we're looking at around 120 billion in gross merchandise volume, whereas only, less than half of that was actually through Shopify payments. If we go now, we're looking at 326 billion and we're looking at 207 million in gross payment volume. So pretty much 2/3 of their gross merchandise volume, or just absolute dollars sold on the platform, is coming through Shopify payments, which is ultimately fueling results. Now, if we look to where this is coming from, you'll notice that the bulk of the growth, it's growing very well in a multitude of areas, pretty much every segment it operates in. But if we look at the highest amount of compound annual growth rate, it is in the United States. We're looking at a 63% compound annual growth rate on revenue in the United States. Canada is not far behind at 58%. We look to Europe, the Middle East, and Asia, 51%. Asia Pacific, 45%. Latin America, 44%. There is not a segment of the business that this company is not firing on all cylinders for. We can look to the Europe, Middle East, and Asia here. Back in 2018, we're talking about a 10x in revenue in this segment, and it's still growing at a rock solid pace. The one thing too, if we exit out of all of this and we go to the company's cash flow statement, we can see that free cash flow is increasing. This company is becoming more profitable. It is very capital light. It has virtually no capital expenditures. And we can see, there was The company was not profitable pre-pandemic. Obviously, they were a new IPO. They were a fast-growing company, but we see 2020 really when it started to become profitable. Obviously, 2022 was that really tough bull market and that really tough slowdown in overall spending. But I mean, now we look from December 2023 till now, the company has effectively doubled its free cash flow generation. Yes, it still doesn't generate a lot of free cash flow relative to its overall market cap. I mean, we're looking at $1.7 billion in free cash flow relative to a $200 billion market cap. However, the company growing at a 40% pace means that this free cash flow is likely to grow at a very fast rate, especially when we look to capital expenditures. We can see that the company doesn't really spend anything. I mean, we're talking about capital expenditures over the last 12 months of $17 million. A lot of the extensive capital expenditures were rolling out the business now, and now it's becoming very capital light and very profitable. Now, if we go back to the earnings, we'll go over the guidance. So they expect in the third quarter of 2025 for revenue to grow at a mid to high 20% range on a year-over-year basis. They expect gross profit dollars to grow in the low 20s, and they expect free cash flow margin to be in the mid to high teens. If it can hit the high teen range, there is likely more upside in this stock at these levels. Right now, it's at 16%. If it can continue to grow that free cash flow margin, continue to grow its margins overall, plus grow at a mid to high 20% range, in this bull market where technology, where AI is at the forefront, these companies are exploding, I would be absolutely shocked if it does not hit the high end of guidance on all these measures, that we don't see pretty reasonable upside from here. Now, the final thing I want to discuss is valuation. There's a key difference between Shopify right now and Shopify back in 2021. And if you look to the company right now, it still seems very expensive. As I had mentioned, 114x free cash flows. It's trading at 85x expected earnings. It has a PEG of 4, kind of estimating that the market is more than pricing in the growth of this company. But the one valuation metric I do want to show you here is EV to sales. So this is a metric that I use to kind of judge companies that are not necessarily profitable or are not highly profitable at this point in time. Their enterprise value relative to their sales is a pretty good way to get a basis valuation of a company. It's obviously not the be all end all, because ultimately revenues are useless in the grand scheme of things. You want to see that earnings growth. But when you have a company that's primarily seeking to increase revenues and kind of drive profitability down the line, EV sales is a very good valuation metric. And when we actually look to, I guess on here it's called EV to revenue, when we look right now, the company is trading at 17x EV to revenue. When we go back to 2021, the company was much, much more expensive today. We're looking at 43x in 2020 and 36x in 2021. And obviously what happened in 2020 and 2021, well, the company fell 80%. So a lot of people, because this company, as you can see, is back up to its pretty much pandemic pricing, we're looking at $213 and we're now at $211. So the company has effectively been, I guess you could say, dead money if you bought it in November of 2021 and you held it until now. So a lot of people are kind of worried about this price point here and the fact that the company might be getting a little too expensive. And I will say that it definitely is expensive here, but if you're kind of basing this off 2021, it is really not even close to the same valuation. I mean, even on an EV to free cash flow basis, we're looking at 330, 346. Right now, we're at 92. I'm pretty impressed at what this company continues to do when it comes to making life easier for merchants. I mean, we have their Shopify Magic tool, which, I mean, I don't really operate in the e-commerce industry, but I would imagine creating descriptions for products, creating discounts, running promotions, building out storefronts, email content automation. I would imagine this is a huge time drag for retailers. So this system kind of aims to automate a lot of this stuff so that you can save time. And ultimately, this is a huge draw for e-commerce platforms and even brick and mortar businesses to come to Shopify. And it creates a very sticky environment where there is switching costs that might not necessarily be worth it. People don't want to leave the platform because the platform truly is the best. These situations that Shopify is creating for e-commerce is causing people to make more money. Utilizing Shopify is causing your store to do better. So ultimately is not a platform that people are really going to want to leave. Now, the other element here is tariffs. A lot of people have been worried about tariffs when it comes to Shopify. But the thing is, only about 1% of total gross merchandise volume is tied to goods coming from China. So the vast majority of Shopify's merchants operate outside of these high tariff zones. I mean, when we think about it, sellers on this platform aren't particularly tied to one country or one product source. A lot of them are on there building their own brands. They're offering their own digital products. They're utilizing local suppliers. So when these tariff issues come into play, it could ultimately impact the stock price, but it ultimately doesn't really impact the business all that much. I mean, I'm not going to lie, the numbers, they impress me. I mean, the stock, it seems a little expensive at this point, but like I said, if the company can continue to grow and even hit the high end of guidance, I do really think there's more upside in the price today, even as we hit all-time highs. I mean, they hold a rock solid place in the e-commerce sector, both globally and North America. I mean, its software pretty much helps businesses of all sizes. So it has a nice, diverse mix of clients, very large, very small. Obviously, you're going to see larger churn during economic downturns from those small to medium-sized businesses, but also the larger players kind of pick up that slack. And overall, I just kind of like the company here. Now, is it as good of a buy at, 213 as it was down here at 38? Obviously not. However, I do believe that the market was overly bearish on it at this point in time. Do I think it's overly bullish right now, especially after this last quarter? Probably. Like, would I look to buy it right after a 20% run up? Probably not. But if you're looking to enter this company, I would not blame you whatsoever. The results are that good. That's it for the video, everybody. We have that premium promotion right now. Hopefully there's some discounts left for you. We only had a handful of them left this morning, so head to the link below in the description. Grab a big discount to your first year of premium with a 30-day subscription back guarantee. You can hop on the Discord, say hi to me, ask me a bunch of questions, whatever you want, read all my stock research, see my own portfolio, my returns. You get my weekly newsletter, you get my custom stock screener. We grade over 5,400 equities on the global markets. And overall, it's just a platform that is helping thousands of Canadians become better investors. And I'll see you next time for more great Canadian content.